Deven Choksey as well joins in on the show right now. Deven, hi, afternoon. We've just been talking about as to how indicators, or rather all indicators, seem to be hinting at more legs for the markets from here. Be it the FI positioning, the comeback they've made, the cash levels that mutual funds are sitting on, the under ownership from the HNI fraternity, all seems to be indicating that there's more green to go.
Yes, Aisha, good afternoon. Of course, I think the fundamentals of the economy and fundamentals of the corporate sector have actually resulted in changing the mood of the investors and the stakeholders in the market. And that is definitely helping the market to come back. And also, fortunately, I think the selling portion has stopped from the global traders, which has probably allowed the market to stabilize. Having seen this journey, I believe that 23-24 remains even more positive than what was earlier envisaged for two reasons. One, importantly, the crude oil prices have cooled down and they are promising to remain at a lower levels. Should that be the situation continuing, then the commodity prices, food commodity and the metal commodity prices, they would also remain under check, and that will probably help most of the companies maintain their margins, which were up till now, I think, affected in the last financial year in some of the quarters. Now, these points are definitely helping the companies to grow with confidence in coming period, because on one side, due to the strong demand situation that we are seeing in the economy, which is continuing due to infrastructure by the government, and also because of the industry's expansion. And on the other side, if the input cost remains under check, the profit margins remain better, so the profits and the profitability. So all in all put together, this is inviting, I think, more attention, and as a result of which higher confidence leads to a better infusion of funds, and that's the steady movement of the market. Maybe today's market is somewhat corrective, having touched the higher levels. I would think that I think with this correction, probably you would see more entry of investors into the market.
Definitely giving more opportunity for market participants to enter because it slipped below the mark of 18,300 as well at the lowest point of the trading session as we speak, Devin. But Devin, wanted to talk to you about the entire defense pack as well. The likes of Mazgaon Dock, Garden Reach, Cochin Shipyard, etc. These are all buzzing in the trading session today. Though it's a long gestation story, would you be a buyer in these names despite the run-up we have seen on a YTD basis?
Yes, I think the run-up is little ahead of time, but that's the character of the market, that's the nature of the market. Market always runs little ahead of time. In my viewpoint, I think many of these defense companies with a strong order book position definitely suggest that they've got better visibility of generating revenue and profits than before. However, the fact that I think defense companies along with railway companies, they normally operate at a tight margin, at a very, very competitive margin. And given that kind of a situation, many of these companies would definitely, I think, produce higher revenue and the profits, but on a smaller or comparatively competitive margin. They don't have enough amount of what is called downside protection or a margin of safety, as you call it, as long as I think the making a mistake is concerned on the margin side. Should that happen, then probably the current valuations may not sustain, and that is the only caveat that one can add at this point of time. Having said that, any corrective downside in the market, which we saw typically in the February and March month, such kind of corrective downside in the market whenever it comes, and I think at that point of time, defense and railway stocks would be once again re-entered into by the investors. If they found it, I think, little expensive at this point of time, I think the opportunity should be to buy at lows during such corrections.
Sure. But Devin, it's a large list of defense as well as railway stocks out there, right? Could you narrow it down perhaps to the two best picks from each?
So I think we have been liking companies like Solar Industries, I think, which has been a relatively a steady performer with probably I think no competition as far as I think their product range is concerned. So that is one company which we have continued to like all along all these times. Uh, in the other segment of defense, I think probably I think one of the newer entrant in the market, it appears a little bit more promising, which is a company called DCX Systems. Looks, I think, relatively more promising company. Though I think their accounting, I think, is highly skewed for the last quarter, vis-a-vis, I think, the first three quarters. I think that's where probably one would not get the consistency of the quarterly results. But otherwise, I think the company looks relatively more, I think, promising at this point of time to add into the portfolio. Similarly, the situation could be for the railway stock. I think many of the companies where probably I think you would have higher opportunities, particularly the likes of BML, they remain relatively more safer as far as I think the outlook goes from the business perspective.
Devin, you have been quite positive about the mid-cap IT space, right? Whether LTTS, LTI, Mindtree, Sand, etc. Have you been nibbling into any more mid-cap IT names?
No, I think the time to remain selectively confident about, I think these names, LTTS, LTI, Mindtree, Science Technology, Tata Alexi, I think is definitely there because I think more importantly in these companies, on one side, I think they are catering to a very niche segment in respective companies are catering to a very niche segment. Some of these companies are also catering to the engineering side of the IT business, and that is probably I think more stronger because I think that is a specialization which the normal IT companies would not probably possess. And as a result of which, I think they have two solid unique selling proposition that they have. On one side, their customers are fully dependent on them, and they would not easily move around because of I think this kind of domain understanding on the subject that this company brings for their customers. Other side, I think the margins are protected relatively much more than I think that normal IT companies would face a problem with their clients. So I think this niche player, they remain relatively more stronger play in the IT pack, though some of them may be quoting relatively at a higher valuation currently. But given the chance in the situation when the correction takes place, probably I think they would remain a buy opportunity because they continue to grow at 25 to 30% rate of growth at least in next 3 to 5 years, that visibility is continuing in some of these names.
Just looking at the realty pack as well, let's revisit those considering they were the biggest movers yesterday. What with the move coming in on DLF after recording its FY23 pre-sales, which was clocked at a record high, and more importantly, them giving a pre-sales guidance of 11,000 to 12,000 crore rupees for the fiscal. Also, 11 million square feet in FY24 worth about 19,700 crore rupees is what they're looking to launch. And that really got the entire street exciting. But before we talk about that, let me take it across to Somit, find out what to expect from Airtel's numbers. Somit?
Well, for Airtel on a consolidated basis, if we see it is expected to be a muted set of numbers. Revenue and EBITDA is expected to be higher by around 2.5%, while the margins are expected to come in flat at 51.4%. But it is the India mobile business number that is the key number to watch out for from Bharti Airtel earnings, and that segment's revenue is expected to be higher by only 1.5%, which is the lowest in the last 10 quarters. And this is because of an absence of a broad-based tariff hike that the company did not take in the fourth quarter of FY23. Now, the EBITDA growth for the mobile business is expected to be around 2%. And this is largely on account of marginally higher ARPU and subscriber base. The growth we are seeing on the ARPU front is largely owing to the hike in minimum recharge plans, which was done by the company in a staggered manner throughout the fourth quarter of FY23. Now, subscriber base is expected to be marginally higher, but there are some analysts who are also expecting the subscriber base to come down for Bharti Airtel in the fourth quarter. So keep an eye out for that number. Now, apart from the mobile business, if you see the broadband and enterprise business revenue traction is expected to be robust, while the DTH business segment is expected to report a sequentially weak set of numbers in the fourth quarter. Now, apart from the earnings, the key things to watch out for would be the management commentary on timing of tariff hike, because that is the key thing for earnings growth when it comes to Bharti Airtel. Apart from that, 5G subscriber base, what are the new trends that they're seeing in 5G additions, along with this the capital expenditure plans, and how they're seeing the broadband growth going forward would be important to track from Bharti Airtel earnings.
Okay, we'll track all of that. Thanks, Amit, for joining us. But sharp dip as far as market is concerned. Nifty is now 115 points lower. The bank Nifty slipped as much as 200 points below the mark of 43,900 as far as bank Nifty goes. Naresh, your take, what do you make of the turn that we are seeing in the markets at this point of time, and should one buy the dip now?
So looking at this as a buy zone, getting into that to 43,800, 43,700 mark on the bank Nifty would be a retest of the short-term breakout. So that's a point one should be looking to buy. Same is the case with Nifty, closer to 18,200, 250 would be a buying zone. Overall, the view remains positive. What we've seen today is a little bit of a correction in the heavyweight names. So we are seeing a cut on HDFC Twins due to the dividend. Plus, you're seeing a little cut on Reliance Industries as well. So it's more a heavyweight based correction trend. The breadth is still pretty strong. So overall, taking this dip as a buying opportunity, at least in the bank nifty.
We just, highlighted what we expect from Bharti, but Jubilant Foodworks is also going to be reporting its numbers. And given that Sapphire Foods has actually seen a slower same-store sales growth, all eyes now are on Jubilant. In fact, Vinny is here to tell us what the street is anticipating.
So in terms of numbers from Jubilant Foodwork, we are expecting a 9%, 8 to 9% growth in terms of the revenues coming in from the company. While obviously on the operational front, we are expecting pressure coming in over there. Profits are expected to see a decline of 45%, while the EBITDA is also expected to see a decline of 11%, and the margins, a sharp contraction, is what we are expecting of around 460 basis point contraction in terms of the EBITDA margins of the company. Now, like-for-like growth, which the company gives us, we're expecting a flat growth over there, nothing exciting, muted growth on that front. While obviously the revenue growth is also just at 9%. Why? Because there's a demand softness that we're seeing, and that demand softness maybe could have impacted even Jubilant Foodworks, and that's why only a 9% growth in terms of the revenues of the company. Gross margins, so we're expecting a decline even and a contraction on a quarter-on-quarter basis as well, so sequentially also, and similarly obviously that comes down to the EBITDA margins as well. Mainly the factors that are impacting the margins of the company and contraction even on a quarter-on-quarter basis is inflation that we are seeing, prolonged commodity inflation, as well as a bit of a negative operating leverage, which could impact the margins of the company. Factors and commentary that we'll be watching out for: like-for-like growth, what is that coming in at, what is the commentary on that for going forward, demand trends across channels as well as across cities and tier 2, tier 3 cities as well, store expansion plans for the company in FY24, how is Popeyes performing, what is the expansion plan going forward there as well, are something that we're watching out for.
We'll watch out for all of that. But Kunal, your take on Reliance Industries as well as ITC, because these two heavyweights are putting pressure on the markets, apart from, of course, the HDFC Twins.
Yeah, ITC could be a good profit booking, stock at current levels, because the stock was overheated. 430.35 was the level for ITC, where the stock had seen a bit of resistance. Yesterday was a day where the stock had actually rallied, but today is a day where the stock is trying to compensate and come back towards the mean point. My sense is that the stock should come back towards at least 410, 405 in this leg of correction. That could be a good zone to buy back ITC or look to buy on dips. Reliance could be tricky because the stock in the last 1 or 2 weeks was just about going very sideways. It was stagnating at the 2,500 mark. I think 2485, 2490 was the previous swing high for Reliance Industries, and the stock was just stagnating at those levels. So we'll wait out for a breakout back again about 2,500 for momentum to come back again. The only concern with Reliance Industries as a chart is that when you typically tend to buy on dips and look out for these kind of opportunities to go long, the stock stagnates for a lot of time before it gets into a breakout mode. So it's always better to participate on the breakout, because the time span reduces significantly and the momentum tends to kickstart quite smoothly at those zones.
Devin, your take on Reliance and ITC?
I believe that I think these companies are basically ready for a higher amount of growth in their business. In case of Jio, the 5G rollout, I think by the end of this year, is expected to generate significantly high amount of revenue for the company eventually, because one after another format which they are contracting, I think they are basically generating significantly high amount of data consumption and also the customer base. For example, the IPL season, till the last we saw, I think they ended up seeing about more than 1300 crore videos, I think, downloaded. Now, given that kind of a situation, when the company ends up charging them even for the micro usage, I think for the videos, I think this could possibly mean that a significant amount of additional revenue coming into the books of the company through just one incidence or one activity like IPL. Similar such kind of activity could possibly generate significantly high amount of revenue and the profits, and then the catalyst would be 5G, as I see. So Geo platform is definitely, I think, a key driver. Another key driver remains, I think, the retail, which is the omni-channel platform that they have, with higher number of store on the ground, and I think the digital connectivity to the end customer. So that also remains strong proposition. And both these verticals are expected to eventually unlock the value for investors by way of separate listing, which Geo Financial Services is currently doing. So all in all put together, I think the Reliance remains a favorite pick because of the strong fundamental subject, I think, which they are probably following. Along with that, I think in couple of years from now, we are also going to see the complete ecosystem of renewables getting rolled out. So that will also be, I think, value accretive. Similarly, the situation with ITC. On one side, I think each of the verticals are making profits for them, including the FMCs and the hospitality business and the agri business, software business verticals everywhere. I think the company is seeing the largest scale happening for them. Given that situation, any correction in the prices of the stock would definitely mean a welcome buy for many of the investors who have missed out this opportunity. I think that next 2 to 3 years from now, this company looks, I think, reasonably on a strong wicket for generating higher amount of return for investors.
Kunal, how much do you think could be the softness on ITC, and then what becomes a buy level?
So, the earlier support for ITC where it bounced back, I think 2 days or 3 days back, was around 416 mark. And then the bounce for ITC is still 430 levels, which means then we can expect the stock to, fall back at least 10 to 15 points further from the 416 breakdown point, which gets, the stock back towards 405, 410 mark. I'll also look at it this way that ITC has been one of the few stocks which tends to get a lot of attraction from option writers, and specifically at the round figure mark. So whether it's 400, 450 strikes, these are very strong strikes for ITC, and typically we've seen that closer to 400 mark, there is huge amount of put writing, which tends to act as a support, and maybe closer to 450 levels, the stock finds a lot of call writers. So I think that's also one of the reasons why I would believe that maybe in this leg the stock may not fall significantly below the 400 mark. 405, 410 could be a good support zone. If the stock or the selling stabilizes at those levels, that could be an attractive buy point for ITC.
Okay, so that's a deep dive into ITC as well as Reliance Industries at this point of time. But in terms of other movers, you have Yes Bank, which is seeing a bit of attraction. We usually don't talk about this stock, but just volume seems to be on the higher side today. CEAT is one stock which is also seeing quite a bit of traction as well. And then, of course, Trident, Birlasoft, these are some of the other names that have been coming on the radar. Devin, your take about this entire urban consumption theme, and I'm talking about the QSR space, PVR for instance, and even the hotel stocks. Which are your favorites in this particular vertical?
Space, definitely, I think all these companies would have relatively higher business to talk about, no doubt about it. However, I think the valuation wise, most of them have ran little ahead of their actual profits that they would be producing in financial 23-24. So frankly, at this point of time in our portfolios, we have no selection probably from this particular list of stocks. So we continue to like the underlying strength of companies like Indian Hotel for that matter. And I think, but we are not putting in a higher amount of money at this juncture, largely because of the fact that we believe that they have ran ahead of time a little bit, and any correction in the price would mean a meaningful downside protection for us to add into the portfolio.
Okay, that's the take coming in on Indian hotels. In the meantime, let's just take stock of what Jubilant Foodworks is up to. We just told you what to expect from the numbers, and then where Sapphire Foods is actually settled in at, considering they actually saw a dip when it came to their same-store sales growth. Sapphire Foods, although it started off weak, has recovered just a little bit from there, about 1% higher. It's important to see also what the global construct is, because Europe, as I see on my screens, is just marginally in the green, largely flat, you'd have to say. The DAX, the FTSE, or for that matter, the FTSE MIB are just about marginally in the green. I would call it flat. And the pre-market rates for the US futures as well are indicating a very, very tempered move. Although Janet Yellen has once again set out the warning that US could default on its debt ceiling come June 1st, but that doesn't seem to be spooking the markets just yet. For our markets though, the weakness continues. We are now at the session lows as we speak, 18,361 on the futures, and down tick 18,314, I stand corrected. A down tick of 100 points is what you're now staring at for the Nifty. M&M Tata Motors, they're actually a top drags. And Devin, I guess after Tata Motors' excellent performance and the way the stock has appreciated, I guess this also falls in the same category as ITC, wherein you are seeing some profits being taken off the table.
It's natural, I think. I think some amount of profit booking by the traders is definitely natural because I think the stock has had a good rally in the last couple of months, particularly post March. I think this both Tata Motors particularly and the DVR, I think both of them have actually appreciated by around 15% or so. So from that perspective, I guess I think it is natural to see some profit booking, but the fundamentals of this company remains, I think, absolutely very, very strong and convincing. On one side, the passenger vehicle portfolio is driven largely by the EVs, and that is where probably higher demand and traction is being seen. So visibility of the business continues very, very strong in passenger vehicle. JLR portfolio, which up till now was a trouble portfolio because of variety of factors. Probably, I think that is also trying to come back into a good shape. Also, the fact that I think the electric vehicle portfolio in JLR from 2025 onwards could possibly promise higher amount of demand for them continuing in subsequent period. And commercial vehicle, which according to me is I think the strongest of the lot as far as I think their business is concerned because of the fact that higher demand is getting generated on commercial vehicle side due to scrappage policy which is getting into force now. And at the same time, higher amount of demand coming in also because of the fact that I think infrastructure spending in the economy is increasing. The fact that I think higher amount of industrial activity is happening in the economy, creating better higher demand for commercial vehicles. So I remain particularly very strong on Tata Motors. Maybe correction would lead to some kind of a price moderation, but that would be an opportunity for investors who have missed out the rally.
Okay, so that's the take coming in on Tata Motors and some of the other auto names as well. In the meantime, Naresh, your take as far as some of these NBFCs is concerned, especially the mid ones, the likes of LIC Housing Finance, even Manappuram for that matter has been fairly volatile, Bajaj Finance as well. Are there any names that you would like to cherry pick from this space?
So out of these names, the ones which have clearly given breakouts are Mahindra and Mahindra Financials, which has done well over the last couple of months. Second, we are looking at L&T Finance Holdings, which is breaking out. That's another stock which is a fresh breakout that looks the most promising at current levels. And then you have IDFC Limited, which has already done well. That still looks interesting on dips. So these are the three names which are clearly showing leadership. Then on the other side, there is something like Ujjivan Finance, Ujjivan Small Finance Bank, Equitas. These are the names, and watching out for the smaller names like Spandana, Satin, etc. So overall, the whole NBFC space looks interesting, but as of now, L&T Finance Holding remains top bet at current levels.
Right. A couple of other active buzzers in trade, while of course a lot of the market is actually seeing a cool off, Tata Motors, M&M, Maruti. So you're seeing a big drag down for autos, which are a rank underperformer, but Bharti ahead of its numbers also is down to 788 levels. Reliance also is down 1.5%. Kotak Bank, L&T, ITC of course is seeing a crack amidst agency scoring sources that both ITC as well as Godfrey Phillips are going to be undertaking a price hike of about 3 to 5%, not across the board in certain specific cigarette categories, albeit. There's also HDFC Bank, but that's an dividend play, which is why that's that adjusted price. There's also ICICI Bank, which continues to lie flat, so it's not really falling. It did not even move up yesterday. TCS is absolutely flat. DRL has given up its gains. Axis Bank is lying flat now. Divi's has cooled off. So has IndusInd Bank. It's only Coal India, ONGC and Bajaj Finance which are largely sticking on with their gains. Even SBI and Infi have eased off from where they were just a short while back. But Deven, we were earlier highlighting about realty and the precedent set by DLF in terms of the guidance that they have set out. How does it spell for some of the regional and smaller realty players, you think?
So more importantly, I think the amount of development that they are having in their hand or the stock that they are having in their hand is suggesting higher amount of visibility. In most of the cases, I think we are seeing the level of stock has come down, and particularly in this segment, I think the buying demand remains absolutely convincing, along with the low-cost housing. In the premium segment of housing, I think the recessionary impact or the high cost of interest rate impact has also not been seen. So all in all together, if you look at, I think all the three space, I think the affordable housing, the mid segment of housing, and at the same time premium housing, in each of them, I think the demand scenario remains absolutely convincing. With higher amount of demand and the conviction remains in tier 2, tier 3 cities where you are having the mid-tier portfolio, which is basically asking for higher amount of sales for most of the companies. I believe that I think that journey continues for many of them. And fortunately, because of the reduced pressure on the input cost, is also suggesting that most of these companies would end up reporting relatively more stable margins, which are more predictable at this point of time than before. So that could possibly argue in favor of some of the companies. But those who do not want to play the quarterly fluctuation into the real estate companies because they take time to deliver the projects, and at times everything won't get reflected into the quarterly results. For them, I think the safer bet, in my viewpoint, would be the housing finance companies because housing finance as a portfolio is growing at a pace of around 20% on a cumulative basis. And that is possibly giving relatively higher amount of stability to long-term investors who can easily compound their wealth around this level if they buy into this particular space. So I would prefer to be on a safer side, playing
Right.
with housing finance portfolio.
Sure. Okay, so that's the take coming in. On that note, we let you go.